Hi, I'm Steve, and welcome to Bytes by Standard Chartered's Global Chief Investment Office. Invest like you shop. When markets fall, investors are nowhere to be seen. After a strong rally, they are everywhere. This is the reason why the vast majority of investors underperform a buy and hold strategy. What we should do is to turn this on its head by investing like you shop. When things go on sale, you should consider bringing forward your purchases to take advantage of the discount on offer. Consider the following. First, a broader allocation is less volatile and therefore less likely to scare an investor into making suboptimal decisions. Second, the broader the exposure, the more confidence you are likely to have that it will recover its losses over a reasonable time frame. And finally, a broader allocation is more likely to be part of a well-thought-out investment plan, rather than a spur-of-the-moment, emotional investment. We know we all hate to lose money. I know I do. Typically, there are two responses to losing money. First, bury your head in the sand and hope markets recover by the time you look at it next. Second, sell everything so that you no longer see red on your investment account. From my perspective, before you make an investment, try to figure out what is the worst thing that could happen and then write down what you will do if that happens. If you have very narrow exposures, for instance stocks, cryptocurrencies, or even select sectors, then you need to be aware that the potential for semi-permanent or permanent losses is high. Understanding this can help you mentally prepare ahead of time if things go wrong and then right-size your investment, hopefully protecting yourself from an emotional rollercoaster ride. If you have an asset allocation that is well diversified across major asset classes and geographies, then your approach is a lot simpler. This is where the "I invest like you shop" analogy works. Not only are losses generally much smaller here, but they can also usually be recouped pretty quickly. If we look at a portfolio of US assets consisting of 60% equities and 40% bonds, since 1950, one-year returns have ranged between -16% and +32%. However, over 5-year rolling periods, annual returns averaged between +1% and +20%. Over 20 years, the returns ranged from +5% to +14%. Of course, there is always the risk that this time is truly different, but rolling returns for 75 years is a decent data sample. Being armed with this knowledge simplifies your life significantly. This means you should be more confident investing regularly in a diversified allocation, for instance monthly, and accelerating your investment should markets experience significant weakness. Thanks for watching. See you in the next episode.